Welcome everyone to this CEE, Council for Economic Education webinar on the economy. I'm John Campbell. I'm a financial economist. I teach at Harvard, and I've recently joined the board of CEE to support its efforts to promote economic and financial education in the United States. I'm delighted to be here with Seth Carpenter, and we're going to have what I hope will be an interesting discussion about the economy and anything else that you would like to ask. So Seth, over to you for a moment.
Excellent. Thank you, John. Yes, so I am Seth Carpenter. I am Morgan Stanley's global chief economist. Prior to being in the private sector, I spent 20 years of my career in Washington, D.C., doing economic policy at the Federal Reserve, at the U.S. Treasury. And on the theme of economic education, the very first year of my graduate education, I had John Campbell as a professor for macroeconomics. So there's something terribly apropos about this whole setting. So thank you.
Well, so we're going to jump right in and we'll start with a little back and forth on some questions that we thought would interest pretty much everyone in the audience. And then towards the end of the time, we'll start to take questions that you can bring to us through the Q&A. But to start with the obvious thing, the title of this webinar has a question in it. Is the economy really changing? I think the last few weeks have answered that with a resounding yes, things are changing. But how exactly? What did the economy look like at the beginning of the year, and how does it look different now? Seth, you follow the economy very closely, so what's your view?
Sure, John. So I would say coming into 2025, the U.S. economy was in a very strong position, surprisingly strong, in fact. So in 2023 and 2024, we had real economic growth, real meaning inflation-adjusted economic growth between 2.5% and 3%, averaging together a little bit closer to 3%. Which for the US is well above sort of historical averages for what's sustainable. And despite that rapid growth, inflation was coming down. Everyone on this call will remember that in COVID, coming out of COVID, there was an historic surge in inflation, getting to rates of inflation we hadn't seen in decades. And yet in 23 and 24, that inflation was coming down fairly notably, despite this very rapid growth. The unemployment rate had touched a low of about 3.5%, come off that low to get to about 4.25%, which again, by U.S. historical standards is pretty low. And we were adding at the end of last year, adding jobs per month somewhere in the neighborhood of 200,000 jobs per month. So if you take that all together, it was a pretty solid performance for the U.S. economy. Low unemployment, continued solid job gains, real GDP growth that was above the long run sustainable trend, and inflation that was still falling. The world has changed, and coming into this year, what we were talking to folks in markets about, other economists about, was the impact of policy changes, potentially dramatic policy changes from the new government, and what that might do to the economy. And we really thought about four key policy levers: fiscal policy, near and dear to the heart of everyone who's ever taught macroeconomics; tariff policy, trade policy, which has been in the news a lot; immigration policy, which was a key subject in the presidential campaign; and then deregulation in the economy. To just go through those very briefly, because it really is where things have changed. I will say, very strongly held view on my part, but in some quarters maybe a little controversial, the deregulation, the fourth lever, I'm not going to talk much about. I personally don't see a huge role for deregulation for top line GDP growth. It matters a lot for individual sectors. I think one place where it might matter more for output would be in energy, especially natural gas. But in terms of shifting the overall outlook for GDP growth, it's a very slow moving beast, and I don't think it has quite that much relevance for top line growth. The others, though, could potentially be very important. Fiscal policy was a topic of lots of discussion in financial markets, and yet coming into this year, what President Trump had said, what Secretary Bessent had said was their priority was to make permanent the tax cuts from the Tax Cut and Jobs Act from years ago when President Trump was president before. Um, One point that I try to stress is making those tax cuts permanent means keeping tax rates unchanged. And the way I think about the economy is if you're keeping the tax rates unchanged, then you're not, in fact, stimulating the economy. And so the idea that the change in policy, the making these tax cuts permanent, would be a big boost to the economy, I think was an unfounded scenario. Now, since then, since the beginning of the year, what we have learned is the Department of Government Efficiency, as it's become known, has been laying off workers, has been suspending or canceling payments in an effort to bring down the size of government. The speed of that action and the very likely size of those actions for me were a bit of news. And so what we have to contemplate then is going from a place where fiscal policy might have been roughly neutral to now a place where we have contractionary fiscal policy with government workers being laid off, payments from the government being suspended. So at the beginning, I would have said we had 2 years in a row of faster than sustainable growth, so we should see a little bit of a slowdown. Now, additional information is contractionary fiscal policy for the year, which should cause a bit more of a slowdown. Immigration policy is another area where we thought we would see a little bit of a slowdown. The surge in immigration that we saw in 2022, 2023, and 2024 was also very large. We got somewhere close to 3 million people net immigration. Lots of younger folks, lots of addition to the labor market, and that supply boost to the labor market was part of what allowed above potential growth while having the inflation rate coming down. What we have seen is a somewhat aggressive approach to deportations, but also, and I think much more importantly, enforcement at the border to interdict entrance into the United States. Now, when we think about what drives the potential growth rate of the economy or the realized growth rate of the economy, the amount of capital in the economy matters a lot, but the labor force is also particularly crucial. And so we think net immigration could fall to 1 million this year. And I think there's a realistic chance it could get to literally zero net migration, in which case that would be a serious drag on the productive capacity of the economy. It would mean that lots of the services sectors in particular could not produce as much as they might otherwise. And then there's also a bit of a demand drag because these immigrants are buying goods and services in the economy and adding to aggregate demand. So that's another place where the change in policy is likely a drag on economic growth. And then the last point is tariff policy. I think everyone will have seen a lot about tariffs in the news. Most simple economic models of tariffs say, okay, tariffs are a tax. And if we have a straightforward, simple intro microeconomics model of supply and demand, and you impose a tax, you end up moving up along the demand curve and you end up with a higher price and a lower quantity. I think that kind of analysis works reasonably well if we're simply talking about finished consumer goods coming in. But we know that China has been the target of a lot of the tariffs, and about 1/3 of what's imported from China are finished consumer goods, and about 2/3 of what's imported from China are capital goods and intermediate goods that go into domestic manufacturing production here in the United States. So partly it's a tax on consumer goods that's reasonably easy to analyze, but it's also a tax on domestic capital spending. It's a tax on domestic manufacturing. And what we saw in very clearly in the data in 2018 and 2019 is when the tariffs were placed on China, then industrial production in the United States fell in the second half of 2018 and continued to fall through 2019. Employment in manufacturing, which had been rising very strongly in 2016 and 2017, stopped growing in 2018 and then started to fall in 2019. So tariffs in general are disruptive for global trade, but I think an underappreciated fact is that they also are negative for US growth, while simultaneously pushing up inflation in the United States, albeit probably a little bit less than maybe lots of people fear. So let me just summarize there because I rambled a bit. The US economy was poised to slow down a bit from last year until this year, and we were thinking the economy could grow something like 2% this year. But with all of the new policies, especially restriction on immigration, higher tariffs, and now some austerity at the federal government, those are three key forces that are slowing growth. And two of them, immigration restriction and tariffs, are tending to push up inflation. And so now we're looking at something like 1.5% growth for this year, possibly lower, and inflation that might end the year somewhere in the 2.75% range instead of having a further decline, as had been the case for the two previous years. So let me stop there, John, and hand it back to you.
Right. So I think you've touched on many of the important factors. I guess the one thing I would add is to think through the effects of not just the policies themselves, but uncertainty about what those policies are going to be. And it's clear there is a lot of uncertainty. Tariffs, for example, tariff policy is moving around rapidly. It's not clear whether we're going to end up primarily with higher tariffs on China, or whether there's also a very serious effort to unravel the supply chains that cross the borders in North America between us and Canada, and between us and Mexico. Still, I think this is to be decided, to be made clear. But I guess I would emphasize, the US economy normally has a lot of momentum. It takes an extreme shock to alter economic conditions suddenly. We can think of examples that we've lived through. Obviously, the onset of COVID-19 in March 2020, the collapse of Lehman Brothers in September 2008. These were very extreme events that sort of put the economy onto a really quite different path. Now, most of the policy actions that the Trump administration has taken, don't rise to this level, at least not yet. Even if we think about DOGE and laying off federal workers, that's obviously going to have local impacts, most obviously in the Washington, D.C. area. But, the federal government actually doesn't employ most public sector workers, who work instead for state and local governments. I know there's a lot of teachers on this webinar, and, you're an example of public sector workers employed locally. So I wouldn't say the things that the administration has actually done as yet do more than shift the economy a little bit at the margin one way or another. And that's certainly the nature of the forecast that you were providing, Seth. I think the concern is whether the uncertainty around policies, if it remains elevated, could turn into a larger shock of the sort that really can change the direction of the economy. So businesses face a great deal of uncertainty about tariffs and about whether Biden-era incentives, for example, to develop green energy, will remain in place. And a natural response for businesses is to postpone investment decisions until the landscape is clearer. Consumers similarly delay large purchases for cars, houses, consumer durables. And that can reduce aggregate demand quite suddenly and provide a contractionary force. We do see that consumer sentiment in surveys of consumer sentiment has dropped really rather sharply, and I think it's a warning of this phenomenon. Investors, for example, in the stock market can take a wait and see attitude when they see falling stock prices. They may not react with a sort of buy the dips investment response, nor at the moment with panic, sell everything, but just by sitting on the sidelines and waiting and seeing what's going to happen. So I think one of the threats to the economy, the downside tail risk for this year, is that the increase in uncertainty will be a powerful contractionary force that could amplify the fiscal contraction and the effect of the tariffs and the immigration policies that Seth was talking about. I guess one other worry that I'd bring up, being a dismal scientist and sharing worries, I think we need to keep a close eye on inflation expectations. In recent decades, the US economy and the Fed have benefited from confidence on the part of most ordinary people that in the long run, inflation will proceed at something close to the Fed's target of 2%, maybe 2.5%, maybe up to 3%, but very, very stable long run inflation expectations. The concern is that that anchor might start to drag and people might lose faith in the ability of the Fed to manage inflation over the longer term. So it's a little alarming that the University of Michigan Consumer Survey has 5-year inflation expectations, the most recent number up at 3.9%. That's the highest level since the early 1990s. I hope that won't persist. Any one survey measure there's a lot of noise. But if that turned out to be a real increase in inflation expectations, it could cause long-term interest rates to rise and hamper the Fed in its ability to stabilize the economy by cutting short-term interest rates. So, Seth, do you have anything else to share on this before we go on to our next topic?
No, I only to amplify or to combine the two messages. One is there are sort of bits of policy, bits of the outlook for the economy that we think we have a reasonable handle on, and that points to slower growth. And in fact, relative to what we thought maybe 6 months ago, noticeably slower growth. But the most difficult part of the forecasting is exactly what you laid out there, John, which is the uncertainty. We have not seen the constellation of policy changes that we're seeing now in history. So it's a little bit hard to use simple empirical analysis to come up with a reliable forecast. And so I think for that reason, your focus on uncertainty, I think, is truly important. The inflation's expectation side of things, again, I think is also critical. We lived through an historically large bout of inflation. For the most part, measured inflation expectations remained under control. And indeed, we saw inflation come off of its peak and come back down as the economy got back to normal, as some of the supply disruptions went away, as people went back to more normal patterns of spending. However, inflation is not back down to the Fed's target now. And so we will now have had several years in a row where realized inflation that people are living through has been higher than normal. At the beginning of the COVID inflation, lots of people said, oh my gosh, are we going back to the 1970s style inflation? And at that time, my answer was probably not. The inflation of the 1970s, especially the late 70s, that caused Volcker to need to induce a recession to bring inflation down, was in fact the result of inflation that had been high for literally a decade. And so that for me was a key difference of the COVID inflation versus the, say, 1978, 79, 80 inflation situation. Where we are now, especially if inflation tracks back up for the rest of this year, it won't quite be a full decade, but it'll be, 3-4 years in a row of high inflation. So at some point, I think the risk that you alluded to ends up becoming more and more material.
So you were referring to, unprecedented things that are hard to predict. And our next topic is very much that, which is the rise of artificial intelligence technology. And what does that do to the economy? We know that in financial markets, AI has propelled an extraordinary boom in the technology sector, led by NVIDIA with its commanding lead in the production of the most advanced AI chips. But what's going to happen next? So let's see what we think about that one. Seth, what do you think?
Sure. I think the honest answer is I don't know for sure, but I've got a few guesses. I would say when I talk to people about AI and what it means for the economy, there's a whole range of views. There are the true believers who believe that AI in short order is going to fundamentally transform at least the US economy, and we will be off to the races with productivity growth and as a result, economic growth higher by multiple percentage points. And then there are the deeply entrenched skeptics who think we're going to get all sorts of wonderful new variations on cat videos on Instagram, but in terms of anything useful for the society, they think of it as simply a glorified spell checker. I think first off, even if those were literally the two options and you weren't quite sure which one, and you put some probability on each, the expected value of those two scenarios is still positive contribution to productivity growth. So I think you can at least have reasonably strong probability that we're going to end up with some higher productivity growth. I think the tricky question is when and how it manifests itself. And the forecast that I make professionally, I've told staff to pencil in something like an extra couple tenths of a percentage point for GDP for productivity growth for this year and next, not because I know precisely how it's going to happen, but because I think it is positive. But history says it takes a while for new technological innovation to be developed, to be adopted, to diffuse through the economy, for the appropriate use cases to be found. And then, in fact, it often takes longer for it to show up in the actual productivity data and the GDP data. Uh, all indications are that this tech cycle is happening faster than historical ones, which is why I'm willing to lean in a little bit this year and next. But I do think it's still probably too soon to see a big change. And in fact, there's a reason why in the very short run, productivity might be a little bit negative, because you have to take people away from their current job to learn how to use the technology. And while they're learning, they're not producing as much as they used to. And so offsetting some of the benefit in the short term seems reasonable. But I do personally think we will see an increase in productivity, at least in levels terms. But because that level shift higher in productivity probably takes about a decade to happen, that's going to look like higher productivity growth, which should lead you to believe that we'll have faster GDP growth once things kick in for at least a decade. All of that is, of course, relative to where we would have been otherwise. And some of the cyclical phenomena we just discussed are going to affect what we realize over the next few years. The last point I'll make on this, though, is a lot of the discussion I hear now about AI and what it's going to do for the economy is about use cases that are becoming popularized. A lot of discussions about call centers reducing the need for workers because they can automate things. There's a lot of discussion about the legal profession, where there's a lot of document review that goes on that can be done much more quickly by machines. I think all of those are super interesting cases, but I would say the biggest benefit to the economy, where we'll see the biggest productivity gains, is going to be from something that we haven't actually thought of yet, where the entire business model is predicated on the existence of AI tools. We don't have that right now. Right now, what we're trying to do is fit AI to existing business models. And so the best example, or one of the common examples I use here, is the iPhone, or the mobile phone, the smartphone with lots of technology embedded in it, including maps and those sorts of things. 2006, the Apple introduced the iPhone for the first time. It was interesting. It was cute, but there was not an Apple store, an app store. And so the actual direct applications were limited. At that point, the concept of the company Uber or Lyft, all of these ride sharing apps, those were not actually possible until all of that technology that's embedded in smartphones became ubiquitous. But once it arrived, then they were able to create these business models using that technology, and Lyft and Uber are now these extraordinarily highly valued companies. And so I think the real sort of measurable pickup in output allowed by AI is going to come only after people have lived with it for a while and create new business models that couldn't exist without AI.
So we have an interesting question from the audience coming in through the chat about the long-term effect of AI on employment, and whether it will, in the very long run, cut total employment. So I know that's something that gets discussed a lot.
Yeah, so I'm gonna abuse my right to throw this back at you in a moment, but my initial reaction is probably not. I don't think. History suggests lots of times where technological innovation, technological advance leaves people unemployed for a long period of time. I like to say you don't look around the US economy right now and find a lot of blacksmiths out of work because people are driving cars and not riding horses with horseshoes on them. What tends to happen is over the course of history with technological innovation is some jobs do become redundant and there's a transition that goes on. And at least subsequent generations of workers then go into the industries that are on the ascendancy and go away from the ones that are declining. Now, the speed of the technological advancement, the speed of the adoption can matter. And for any single generation of workers, there can be hardships, sometimes persistent hardships. And we've seen with the Industrial Revolution, people leaving farms, going to cities, having to deal with sort of difficult circumstances until the economy progresses. And I don't want to diminish any of that, the frictions and the complications with the adjustment to new technology. But the question was about the long run. And my very strongly held belief is in the long run, we'll get back to something like full employment, especially if the aggregate demand policies are appropriately calibrated. And we'll just see a shift of which industries labor goes into. But John, you've been a macroeconomist longer than I have. What's your take on the
Well,
question?
no, I very much agree with that. I mean, there's a related question, which again, somebody's posing to us, which is what happens to the distribution of income and the sort of effects on different types of people. And I think the jury's out on that, actually. Uh, we've seen there's some types of automation that reduce manufacturing employment, right? Traditional manufacturing employment has shrunk very steadily, even as output has grown. And that's a long run technologically driven trend, which long predates AI. I think there's clearly going to be some routine jobs. You mentioned the work of that a lot of paralegals do, searching documents in law firms. Clearly, that kind of work is going to be automated. But you're going to see both the emergence of you're going to see two countervailing forces. Seth, you mentioned the emergence of completely new jobs as the economy transforms. That's certainly right. The other force that I think we need to keep in mind is that there's what economists call an elastic demand for a lot of things. In other words, there are things which, when they get cheaper, we consume more of them. A good example here actually is energy. Sort of in the short run, perhaps demand is inelastic. If you still need to heat your home in the winter, even if the price of doing so goes up. But over the longer run, the demand for energy is very elastic. And as energy becomes cheaper, we just use more and more and more energy. So that then keeps up employment in the related sectors. And I think we may see some of this going on with AI, that we just find certain things that were very painful become cheaper, easier. We want to do more of them. And so even though each individual worker is more productive, there's plenty of employment to go around. I'd like to, before we leave AI, I'd just like to introduce the topic of the financial markets and the stock market in particular, and the valuation of technology companies. Up until now, investors seem to have thought that AI would be like the existing tech sector, in which a few very large platform companies, think of Alphabet, Amazon, Meta, Microsoft, they dominate. New entrants can't compete very easily because a platform is more useful the more people use it. So a dominant platform has a natural monopoly. And people have thought that large language models might be similar in this regard, and that whoever gains the lead in AI is going to be a dominant firm. I would say recent developments are casting some doubt on this. I mean, it seems to be cheaper to train these large language models than people feared. The Chinese company DeepSeek has sort of shocked the markets, and my fellow economist Olivier Blanchard called that the largest positive productivity shock in the history of the world, which is perhaps a little bit over the top. But But it also seems to be true that you get better results with these models if you run them more intensively and repetitively, and that uses more energy in the process. So it may be that the fixed costs of creating the big model are lower than was thought, whereas the marginal cost of operating it may be higher. And that might move us towards a more competitive marketplace without large advantages for the big platforms. And that could be good for consumers and the economy as a whole, even if not so good for investors in NVIDIA and the other so-called Magnificent Seven large tech companies.
Yeah, so I think that's a great insight, John, and I'm sympathetic. I think the DeepSeek example is critical to keep in mind because it's very easy for the human mind to extrapolate patterns that we see. And for a long time, everyone was just extrapolating the NVIDIA sort of US-based large language model idea almost to infinity, and DeepSeek fundamentally shook that. I think what is being learned is that not only you were talking about average cost and marginal cost of these things, I think what's also being learned is that the marginal benefit of some of the large language models is falling. They are getting better and better and better, but to get the same incremental increase in performance takes astronomically more work intensively to get there. And so I think that fact is critical. But I also, to go back to an older technology cycle and maybe to harp on the mobile phone example I used before, um, you will almost surely remember when Nokia was a dominant player in the cell phone market. I think my first cell phone, although I talk to people in their 20s and 30s these days who are astounded that I had a mortgage before I had a cell phone, but my first cell phone was a Nokia, and I now know no one who has a Nokia phone whatsoever. And so again, I think there's a caution to be learned from history, which is players that are categorically dominant at one point in time can easily be overturned later and end up being relics of history rather than we are not necessarily playing for keeps here. We're playing for dominance right now, and things could change again.
So you mentioned a mortgage, and one of our other topics that we were hoping to discuss is housing and mortgages. And that's on many people's minds because housing is exceptionally unaffordable today. Since the start of the COVID pandemic 5 years ago, national average house prices in this country have risen by about 50%. While at the same time, 30-year mortgage rates have risen they were around 3% 4 years ago as we came out of the pandemic, and they're almost 7% today. So that makes life exceptionally difficult, particularly for first-time home buyers trying to get onto the so-called housing ladder. Now, I think one of the interesting puzzles, I'll start out with this observation. It's a puzzle that the big run-up in mortgage rates that we saw in 2022, 2023 didn't push house prices down more than they did. House prices just kept rising. They paused a little bit and then they resumed increasing. I think one reason is related to the mortgage system we have in this country. In the US, fixed rate mortgage system, anybody with an old cheap mortgage will have to give it up when you move. And people are understandably reluctant to do that. And that's created a phenomenon known as lock-in, whereby, few houses are for sale. And there are some desperate buyers, they'll pay top dollar for those houses that do come on the market. Lock-in is a pretty bad, I think, for the economy as a whole because it slows down the adjustments that need to occur as people move in search of opportunity. But it's not a permanent phenomenon. It will gradually wear off as people get used to higher mortgage rates and there are fewer of these locked-in sellers. So, we may expect housing market conditions to normalize with downward pressure on prices. But Seth, do you have a view about where housing markets might be headed?
I do, and I think, John, all of your points are spot on. The affordability side of thing, in particular, one of the measures that we do, other people in macro analysis do, is to look at the median home price assume a 20% down payment, look at the current mortgage rate, and then calculate what the implied monthly payment is, and then compare that to the median income. And that gives you some gauge of affordability at the median for the economy. And by that metric, home affordability is literally within a couple of points at the worst affordability it's been in several decades. And so the commentary you hear from folks in their mid 20s and mid 30s is absolutely justifiable in the data by that metric. I think in the short run, all of that evolution that you talked about is right. I think there's a slightly more fundamental low frequency problem that sort of will take at least 5 years, if not a decade, to resolve, which is historically in this country, it is the age cohort between 25 and 35 that are the first time buyers. And if you sort of accumulate all of those households that have been created and that are likely to be created and look at where the housing stock is, we actually have a fairly substantial shortage of housing relative to those historical averages of home ownership for 25 to 35-year-olds. And so I don't personally expect there to be any sharp correction in home prices, even with mortgage rates having been as high as they are. I do think mortgage lock was a critical short-term phenomenon in preventing much of a sell-off. We might not get as rapid appreciation for homes over the next few years as you might have otherwise expected if the economy keeps going. But I think there is more of a floor underneath home prices for a while, unless and until there is a change in the way that supply of new housing works. And the challenge for this is that is all about regulation at the very, 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 very local level. I live in Manhattan, and so what you're talking about there are challenges of regulation and permitting in the city, in the borough, in the city, in the state. So in the borough, in the city, in the state, and then because New York City isn't just in New York, it's also New Jersey and Connecticut, you have sort of cross-border issues. I often personally think of public transit as a direct substitute for affordable housing. And so when you take all of those things together, finding a way to address the chronic shortage, I think is difficult. And that for me says there's in fact not likely to be that much of a housing correction thinking about pricing or affordability relative to median incomes for quite some time.
Yes, and you know the house prices have important, I think, political and demographic implications. You know, high house prices are one of the forces that I think has driven political opposition to immigration, particularly on the right. And on the left, you know, there's conflict, I would say, between what are now called YIMBYs, you know, yes in my backyard, pro-housing progressives against the more traditional NIMBYs who say no in my backyard. So there's definitely going to be political conflict surrounding these issues. And then finally,
Absolutely.
yeah,
Sorry, I didn't mean to cut you off, but I think it's
yeah.
also helpful, especially in a group of educators about economics. Um, Over the last year, especially during the presidential campaign, we heard lots of discussion of people still being angry that inflation was one of their biggest concerns. And a lot of economists would say, what are you talking about? Inflation was at 6 or 7%. Now it's down at 2.5%. Inflation is so much better. And I think it entirely misses the point from how households and consumers are looking at pricing and the pricing phenomenon. Now, some of it is terminology, and that economists would insist on separating the level versus the first derivative feels a little bit overly pedantic to me. But it's also what cognitive psychologists and some economists would call the salience of certain prices. And home pricing, housing pricing is something that is front and center in lots of people's minds. So even if the aggregate measures, the aggregate indexes of inflation came dramatically off of their peaks, the prices that people are confronted with, food, gasoline, those have come down, but people focus on the ones that go up, like eggs in the recent history. But also housing is critical there. And I do think for younger people who were already feeling somewhat frustrated with the slow pace of increase in real income at the middle of the economy, middle of the income distribution, this housing price acceleration has to be felt that much more acutely. And I think it helps to resolve a little bit of this seeming dissonance between those of us who are purists of terminology about inflation versus sort of the emotive response that a lot of people had that inflation is still a huge problem.
Absolutely. And I'll just bring in one last aspect, sort of very long-term effect, that there can be demographic implications of high house prices. There's a lot of evidence that people are reluctant to start families when they can't afford a home that they regard as suitable for that. And that's seems to be an important driver of some of the demographic trends, not only in the US, but in many other countries as well. So we're beginning to get some questions coming through the chat here, and I'd like to make sure we address some of them. So, one question brings us back to sort of core topics in fiscal and monetary policy. The question is, if Doge is successful, do we think it will lead to less bond market pressure? Where could the 10-year yield go?
That's a great question. I think, at the risk of being the person I criticized before, I think definitions matter a little bit here. I'm going to just assume that this person means if success for Doge is reining in the overall size of the federal government, and in particular, reducing the deficit relative to GDP. So if I'm allowed to use that as the definition of Doge being successful, I think the answer is it seems very likely that there'd be some downward pressure on longer term interest rates because the supply of treasury debt outstanding would be less than it would be otherwise if you have a smaller deficit. So I think in that regard, a smaller deficit, literally all else equal, you should think at the margin there's a bit less of pressure on longer term interest rates. I think there are a few key caveats here, though. One is historically business cycle fluctuations, expansions, recessions tend to have a much larger effect on where longer term interest rates are than does the budget deficit of the federal government. And so we have seen the interest rate on the 10-year treasury yield, 10-year treasury note fall dramatically this year. It was at 4.8% in January, and now we're closer to 4.2%. That 60 basis point decline is almost entirely reflective of the market worrying about a near-term slowdown in the economy. And so I think there will be a big challenge. Why are interest rates coming down? I think it's generally clear they go down when the economy slows. Contractionary fiscal policy tends to cause the economy to slow down. So I think contracting the federal government, contracting the economy will cause interest rates to come down, but that won't be hopefully a permanent phenomenon, because when the economy recovers, interest rates recover. The empirical estimates are that what we call the term premium effect of the supply of treasury debt is there, but it's not huge. And then I would say on top of that, remember, we have a central bank who is trying to have maximum sustainable employment and 2% inflation. And so if in the long run we get back to 2% inflation, but we also have a smaller government, we have less treasury debt outstanding, and treasury yields would be lower than they would be otherwise, that would be by itself a bit stimulative to the economy. In fact, probably if we were already in equilibrium, stimulating the economy further then would lead you to having higher inflation. And so the Fed would in turn have to run monetary policy just a little bit tighter to be able to achieve their long run goal. So I think there's a bit of a partial equilibrium, as we like to say in sort of mathematically driven economics, sort of a short-sighted or just one looking only at one part of the equation story when people are hoping that the success of Doge leads to lower interest rates. I don't personally think the story that's being told is the right story, but I do think interest rates have come down. I mean, I know that interest rates have come down, and I think they will come down even further the more Doge is cutting government spending. But I think it's much more a cyclical phenomenon than it is because of the deficit.
I think I would also emphasize the difficulty of the task of achieving some sort of budget balance for the US government. I mean, because we've had really quite loose fiscal policy. The measure I like to look at is the so-called primary budget deficit, which is essentially comparing spending to taxes, leaving aside interest payments. And, in the long run, to pay off the debt or to stop it from blowing up indefinitely, the value of the debt has to be financed by a stream of primary surpluses that are sufficient to cover it in the long run. But, we had a primary deficit of about 3.3% of GDP in 2024. And as Seth mentioned earlier, the main thing the Republicans in Washington would like to do on the fiscal side is to extend the 2017 tax cuts. So, that actually can't go on forever, I don't think. Well, historically, how has budget balance been achieved? One way is through growth, and if indeed AI is very effective at raising productivity growth, or for any other reason, if we enter a productivity boom period, that would really help. But otherwise, it tends to be adjustments in spending rather than tax rates. And the difficulty is that Social Security and Medicare are very, very much protected, and we're in a global environment where defense spending probably needs to increase rather than decrease. And there's just not that many places to cut. So I guess I would say that a lot of what Doge is doing is theatrical fiscal policy rather than a true move towards budget balance. And I don't honestly know how that's going to be resolved. Um,
So I'm sympathetic to that, John. I would add to what you said. You said historically, the deficit has come down through reductions in spending. I think that's demonstrably true in the historical record. It's tended to go up partly through spending and very much through tax cuts. And so I think there is a bit of an asymmetry there that's important to keep in mind, especially if you were to compare, for example, the domestic non-discretionary spending, domestic non-discretionary non-defense spending as a share of the total budget or as a share of GDP. That's actually at the lowest level it's been in a very, very long time, which is a long-winded way of saying what you wrapped up with, which is there's actually not a lot to cut there. So I think the talking point that we should be able to cut spending in order to achieve budget balance, I think flies in the face of arithmetic.
So we've got another question in the chat, which is asking us to compare the US and Europe. And the questioner says, the US has seen faster growth in recent years, in part because of more stimulative fiscal policy, but now Germany and Europe more generally look likely to start spending. Could that narrow the growth gap between Europe and the US?
Yeah, so I can jump in first. I was actually in Frankfurt and London last week, and this was a topic of lots of conversation. I think the short answer to that question is yes, absolutely, in terms of narrowing the gap. I would say looking over the past 5 years, the US was growing faster than Europe, partly because of fiscal stimulus. But also, again, thinking about fundamental drivers of economic growth, we had much faster labor force growth in the United States. Europe is further along the demographic decline, and so their labor force growth is quite weak. And I think those two together are really important to remember. And then on top of that, productivity in the United States is and has been for quite some time faster than that in Europe. And so I think it's a whole set of factors, not simply fiscal policy. Looking forward, though, there is a change in fiscal policy, but it is important to remember that the news over the past couple of weeks have been essentially just about Germany willing to increase defense spending. They're reaching a deal. They've reached a deal, and it looks like the numbers are meaningful to increase growth. However, I think people should be a little bit cautious here because Europe has started to ramp up defense spending for the past couple of years a bit anyway, especially following the Russian invasion of Ukraine. And the capacity to produce a lot more military equipment right now in Europe is actually quite limited. And so one of three things is likely to happen with the total quantum of money that Germany wants to spend. Either they're simply not going to be able to spend all of it because of capacity constraints, which limits how much of a boost you get, or they're going to want to spend it only within European produced military output, in which case you're just going to have to extend the time horizon over which the spending happens, which means that each year the growth implication is smaller. Or they're going to have to buy a bunch of, in shorthand, US F-35 fighter jets, which could allow them to ramp up their military spending much more quickly, but it doesn't stimulate the European economy if they're doing it through imports from the United States. And so I think directionally, there's no question European growth, whatever you thought about it at the end of last year, you should be a bit more optimistic about where the growth numbers will be. I just feel like right now people are a bit more optimistic. The convergence of growth for the US and Europe, I think, is mostly going to happen by slowing growth in the US for the reasons that we talked about at the beginning, and only a little bit because of faster growth in Europe.
So we're approaching the end of our hour, and there is, one final topic that I think we really should cover, given that our webinar is sponsored by CEE, and the audience contains, many educators. One thing we should discuss is how economic education can help people. What is it that people actually need to understand, and how can we help to get them there? I'll just say to warm us up that CEE promotes two types of K through 12 education: general economics education and personal finance education. And when talking to many state governments, it looks as if personal finance is the easier sell, but I actually think good personal finance education involves a lot of economics, and the broader perspective is in fact highly valuable. To give one example, when you're dealing with a financial professional like an insurance salesman or a stockbroker, you should always ask who's paying that person and how do they get paid? What are their incentives in this transaction? And attention to incentives is one of the hallmarks of economics. So I think these things go together, and I think they're actually very important for helping ordinary people navigate the very complicated financial system that we've created. But Seth, do you have any thoughts on how the role of education in all of this?
I do. I think there is a key role of economics understanding, economics education, just for helping to create a better informed, more engaged, democratic population. So after graduate school for a few years, I was a professor, and in the introductory macroeconomics class, I would often start off with students saying, I see part of the role of this class is making sure you're able to read a newspaper and digest it intelligently. And so what do I mean there? A lot of policy, a lot of government drives economic outcomes, and we vote for those sorts of things. So we can think back to, for example, the financial crisis. Lots of different roots there, but a big part of it was a housing market that had got well over its skis, overinflated, and then it collapsed, and we saw a lot of the fallout through the financial sector, and then it spread to the real economy. I think a well-educated populace would have thought a bit more about some of what was being sold to them about housing policy, that maybe everyone should be able to afford a house at very low prices with subsidized mortgage rates, regardless of what your income is. I think aspirations of people being able to afford their own home make sense, but having it be appropriately calibrated for risk and income also makes a lot of sense. And I think some of the promise that was sold in policy may have been overdone, helping to contribute to that downturn. Similarly, though, education lots and lots and lots of empirical studies have shown that higher levels of education, better education leads to a workforce that has better attachment to the labor market, higher productivity, which leads to better economic performance overall, higher GDP, higher incomes for folks. And so as a result, when people are voting, should we devote more resources to education, fewer resources to education? Do I care if some of those resources are just going to my children or to all the children in my neighborhood? I think understanding more about the role that education plays in aggregate economic performance, the role that it plays in sort of income outcomes for people, that sort of extra education could probably also help with a more informed electorate.
I think I agree completely. I think I would also say that education can play a role in determining how well markets work. We talk a lot about market power, monopoly, the concern of if the economy is dominated by firms that have some degree of monopoly power, that's going to be bad. Well, where does monopoly come from? One place it comes from, and I think this is really relevant in the financial sector, is that people are reluctant to shop for financial products. They just dislike thinking about finance. They feel uncomfortable, uneasy. There's a lot of evidence that people leave a great deal of money on the table by not shopping, for example, for mortgages, or by not shopping for the best savings rate, the rate on a savings account. So, there are many large banks that get away with paying rates close to zero on savings accounts, even in today's environment where the short-term interest rate is close to 5%. So I think education can help people shop around, and that in turn can help make the economy more competitive and work better. So we are almost at the top of the hour, but I really appreciate the flow of questions and the many educators in this audience. Some of the questions that have come through in the chat have expressed concern about whether AI is going to put human educators out of work. I would say I'm very optimistic. The answer to that is no, that AI will actually increase the effectiveness of education, but leave a really important role for human educators, and will be able to do more and reach people more effectively.
I'm sympathetic to that point, John, and I would add, one of the use cases people have for AI is writing computer code, and all of the evidence there is that it can make the worst computer coders as good as, say, the median computer coder, or maybe the 60th percentile. But for people who are truly excellent at coding, it can make them faster, it can make them better, but it's never going to take their job away. And so I think the challenge for educators is not to try to suppress AI, which I think of at this point as a fool's errand. It just won't work, but rather for the motivated educators to find ways of using AI tools to cater their teaching to individual students. I know my mother was a teacher, my oldest brother is a teacher, and one of their biggest frustrations when they had large classes was always, I wish I had more time for each individual students because there's a heterogeneity and I can't tailor the lessons to each of the students. And I think AI tools over time will hopefully provide a bit of extra flexibility in that regard. And so I think there's lots of reason to believe AI will, in fact, enhance teaching as opposed to replace teaching.
All right. Well, I think that's a very hopeful note on which to end, and this is a hope that I share, and certainly am trying to work on in my classes at the college level. And I wish all the educators in this audience the best of luck in promoting education in general and economic education in particular. So thank you very much for coming this evening.
Thank you for letting me join you, John.